Okay, so thanks a lot for inviting me to give talk to this very interesting and open-minded conference. Initially, you actually asked me to talk about financial stability, regulation, and then, you know, having next to me the great mind of regulation with Martin, I thought I should differentiate a little bit. And I'm focusing the talk on something that might be of a worry for future financial stability, which is digital currency price dynamics. The paper is joint work with Emanuel Münch at the Bundesbank and two other junior at Frankfurt University, Soren Karau and Nora Lammerstoff. And so what we actually do in this paper, we look at both empirical and theoretical explanation of what would be the determinants of digital currency dynamics. I mean, digital currencies in general, blockchain, are going to be a large part of future financial systems. So let me start a little bit from the motivation of why digital currencies price fluctuate so largely. It is quite obvious to us that this cannot be a supply-side phenomenon because, as probably most know, Bitcoin in particular are determined, I mean, the supply of Bitcoin or in general digital currencies is fixed, is completely fixed because it's automated from an algorithm. So there's no possibility of discretionary policies determining inflationary dynamics. And it's very unlikely that fundamentals are going to determine the fluctuation in prices of those currencies because there is no, I mean, they are very little used as a medium of exchange, and there is no monetary policy that is targeting fundamentals and is affecting the supply of those currencies. So much of it is largely speculative phenomenon and demand-driven motives that is determining the fluctuations. So also based on the institutional characteristics of these markets, we target basically two elements. One is investor sentiments, and the other one is minus competition. So investor sentiment is really a proxy in our case for demand-driven motives. So there are investors that are directly trading in these currencies over the blockchains. They are also indirectly trading, as I will explain in the model, through dealers. But of course, there's their sentiment, so whether there is optimism or pessimism, is largely driving the demand, and with the supply being fixed, that's very intuitive that is going to largely affect prices. The other thing is that those investors are trading in a market that is likely to be subject to surge friction because the investors have to meet with each other into those markets. And the validation services, so how fast those investors meet with each other, is determined by miners who compete on speed. So our conjecture that we're going to validate with the data is that the extent of surge friction in those markets, so the extent to which investors meet with each other and trade, depends very much on how fast miners are going to validate this. And so they are going to, the competition among those miners, let me remind for people who are not familiar, so miners are basically, they provide validation services for this currency like banks do in a payment system for regular currencies. And so if there is any surge friction, so whether investor demanding the currency and supplying the currencies, if they have any problem to meet into this market, the miners are the ones that allow this meeting to take place. All right, so the way we proceed here is basically in three steps. So first we provide some agnostic evidence of what are the determinants of and to what extent the two elements we highlighted, so investor sentiments and miners competition, are going to affect digital currency prices. And the way we do it is using a unique data set on Bitcoin prices. Then on step 2, we're going to rationalize our evidence through a model. And in step 3, we're going to dig further into the evidence by having a more structural model for that. The step 1 is very, very simple, because what we are going to do is to use local projections in which we regress prices and quantities of Bitcoin over 2 shocks that are going to capture our ideas. So the first one is related to the investor sentiments, which we model through narrative approach, or basically by collecting events from the media, events that indicate whether investors have optimism or pessimism about Bitcoin. We try to separate from those events that are strictly related to prices to avoid endogeneity. Other than that, I mean, we collect major events that would suggest that investors become optimistic about Bitcoin, hence they wish to increase their demand. We also collect events related to mining competition. So miners, when they validate those services, I mean, miners are fully competitive, contrary to banks that operate in payment systems. But when they validate those transactions, they have to solve cryptograms. And to solve cryptograms, they use algorithms. So basically, any change in entry cost of these mining markets, which is captured by electricity cost in running those algorithms, and of course, anything related to the difficulty of those algorithms, is going to affect the entry cost, and is so going to affect the miners' competition. One way we measure this electricity cost, we have, I mean, we know that many of those mining pools are operating in China. And so most of the electricity cost comes from 2 provinces of China. So we look at events as changes in electricity costs in those 2 provinces of China. And again, we proxy that as the entry cost, so reducing the intensity of mining competition. Then we rationalize our evidence, which is mainly, I should of course probably elaborate more on that. So what we find here is that any increase in optimism is going to increase prices. That's pretty intuitive. So optimism of investor increases demand, and so in any market trading system, that's with fixed supply, that's going to increase prices and quantities. And the second thing that we find is that any reduction in electricity or hardware cost, which means basically any reduction in entry cost of miners, by increasing mining competition, implies that transactions are validated much faster. And when transactions are validated much faster, that also fosters trading, so it increases volumes, hence it increases prices. So our agnostic evidence, so to speak, tells us that any increase in optimism or any increase in miners' competition is going to increase prices. In order to rationalize this evidence, we take modern search and matching type of models with heterogeneous agents. In particular, we look at an extension of the Lagos and Rocheteau econometrica, where basically, I'm going to describe mainly intuitively the structure. There will be some equation in the slides, but they are there just for the purpose of people interested to look at what we are doing. So the idea is the following. So it's, there is a distribution of investors that wish to invest in the currencies. There is an ex ante exogenous distribution of their sentiments, which we capture as beliefs or preferences, and we can also distinguish optimism and pessimism. There will be, these investors will enter the market. And they will trade in actually 2 sections of the markets: a direct trading network, which is really the blockchain, where investors meet directly each other, and where trading is validated or completed through miners. But they can also invest in an over-the-counter that is intermediated by dealers, and their dealers' bargaining power affects, so to speak, the speed by which those traders can complete the transactions. a very important thing is that, of course, some market clearing condition in each of those markets implies that given the ex-ante distribution of buyers and sellers, I mean, here obviously naturally optimists are buyers and pessimists are sellers, there will be, there will be a market clearing condition that will determine also an ex post distribution of those buyers and sellers and will affect prices. Intuitively, once more, if there is an increase in the percentage of optimists, demand of the asset is going to increase, and so through the market clearing condition, this is going to affect prices. Equally, given that transaction takes place in this market with such friction, if there is going to be any increase in miners' competition that reduces that increases the speed of transaction, so reduces the waiting time of the blockchain, it's going to increase volumes, hence prices. Now, the model puts a little bit more of structures into the evidence that we described before, and so the next step is that we're going to dig into further evidence using VAR, so time series methods, where basically the structure that we impose to the vector autoregressions is some sign restrictions which are based on the model. So here, even here, we have a number of variables which are also more model-based. So on top of prices and volumes, as we did in the previous time series analysis, we're going to add also other variables like confirmation times, but also hash rates, which is related to how much miners are investing into the technology, which is a measure also of how fast they're going to trade into this. And we are going to test the same type of shocks, but now those shocks are going to be identified to sign restrictions. So the sentiment variables, because in this case here we cannot simply measure sentiments through a few events. We need a time series that is long enough. So now we construct for this type of analysis our sentiment indicators based on Google Trends data. So we look into Google Trends on how many times people search for the word Bitcoin or digital currencies or anything related to that. And also there we try to distinguish optimism from pessimism. And in terms of miners' competition, here what we do is we look at the excess hash rate. So the hash rate is basically gives a measure of how much miners are investing into the technology to solve the algorithms. The average hash rate determines a confirmation time of 10 minutes. But if there is any, in the short run, any increase in the investment of these miners, this is going to speed up the confirmation time. So again, there is more competition into the miners market, there is faster validation, there is more trading, and this is going to increase prices. Right, so I actually anticipated much of the results that I discussed in the slides. So the main message that is going to come here is that optimism and pessimism, so investor sentiments, is going to play a big role into these currencies. So contrary to more traditional currencies where the idea was that inflationary spirals were driven by discretionary central bankers or they were very much related to fundamentals, in the case of digital currencies, this is much more purely of an asset, a speculative asset, and so investor sentiments and their expectations is going to play a large role. And second, market structure is going to play much more of a dominant role, meaning that in traditional payment systems where other currencies are transacted, banks are the ones who receive a license from the central banks, and so they have a monopoly power to perform the payment system services. In this case, the payment system services, so the validation of transactions, is done by fully competitive miners who can enter the network at any time. And so the extent of their competition, which is mainly related to this innovation game that they engage in, is going to affect the validation services, hence volumes and prices. So what I do here is basically to summarize our three steps arguments, which again, through the local projection, sentiments and minus competition is going to an increase in optimism or a decline in minus competition increases prices and volumes. We confirm that evidence through a search model of the markets for Bitcoin, where investors are heterogeneous and differs with respect to their sentiments. And next, we reassess evidence, empirical evidence, to vector autoregressors, where we basically impose sign restrictions, where we identify shocks through sign restrictions based on the model. So let me show you, also more directly the results. And they are going to be very, very simple. So as I said, in the local projection, what we do is we regress prices and volumes, which you can see here, onto type of shocks, which are identified outside of the model. So the sentiment shock, as said earlier, is based on an indicator that takes a value of +1, -1, so optimism and pessimism, just based on a selection of events. And as you can see here, a positive shock to sentiment, so an increase in optimism, is increasing prices and transacted volumes over the blockchain. And what is very interesting is that actually the shock has a quite persistent and not short-lived impact. So here is instead what I described before as a fall in the minus cost. So this is a fall in electricity. You can be generally proxying a fall in electricity prices in China, or a reduction in the difficulty of the algorithm. And as you can see here again, this by increasing the number of miners that enter the network, and so by increasing the provision of validation services and reducing the waiting time, it increases the number of transactions and prices. I'm going to skip models, equations, and for the interested readers, you can come back to that. So as said, in the models is basically, so here is just a graph that is produced out of the model simulation. So just to remind you a little bit the model's element, there are two markets. There is a distribution of heterogeneous investors that goes from optimism to pessimism. Based on, investors solve a continuous time maximization problem of their value function. And based on the solution of this continuous time maximization problem, and based on their sentiments, so their beliefs, whether they are optimists or pessimists, they decide whether to become buyers or sellers. Once the distribution of bias is determined, given a fixed supply, the market clearing condition that takes place in the two markets is going to determine prices. And once more, a key element of the model is that there are search friction in both markets. So trading doesn't take place instantaneously, and the search friction, by introducing a waiting time, are going to affect prices and quantities. So the larger is the trading friction, the lower is trading, and the lower are prices fluctuations. Now, what determines the frictions in this market? So what determines the waiting prices? It's a competition game among miners. So miners freely enter this market, and they decide, they know that they will receive a fee, or they will be rewarded only if they are the first to validate the block of transaction. So there is really a competition on speed, which you can think of a Bertrand competition on speed. And in order to beat the competitors, so in order to be the first to validate the block, what those miners do is to invest in R&D. So they invest in innovation, so they try to upgrade the algorithms to solve the cryptograms so that, that they're going to be very, very competitive on that front. The miners market has, of course, in the model as well, an entry cost, which is given by, which is calibrated in the model based on, again, electricity cost and difficulty of solving the cryptograms. So given this model ingredients, what happens is that two elements play a key role here. One is the investor sentiments. So if there is a shift in the distribution of investor sentiments through having more optimism, so let's say the upper tail of the distribution becomes fatter, and so there are more optimists, this implies that more people turn into buyers, and given the market clearing condition and given the fixed supply, this will increase prices. And that's what this graph is showing numerically. There is the shock is basically a temporary one-time increase in the tail, in the upper tail of this distribution of miners. And what you see is that the volumes that are transacted in the direct network, which we call the blockchain, increases. The price follows simply from the market clearing condition. The electricity costs do not change because in this case the shock is a sentiment shock, which you see in the bottom panel on the right. Because there has been an increase in the demanded volumes, there is somehow more business for miners. So miners wish to invest in this algorithms, and that's this is captured by the increase in this hash rate, which measure the extent of investment of the miners. Volumes increase not only in the direct network over the blockchain, but they increase also on the over-the-counter. The second shock we consider here is a decline in miners' cost, or if you want, the moment that there is a decline in the entry barriers of the miners' market, more miners enters, and so they are going to invest much more into the algorithm to solving these cryptograms. So the first thing that you see is that in response to a decline in the electricity cost, which is the center panel of the figure, there is an increase in the amount of investment in R&D for the miners, which is the hash rate, which is the left panel in the middle. Given that transactions are now validated much faster, the volume, both over the blockchain and over the exchange, so the second panel on the top and the last panel on the left, volumes increase in both markets, and as a consequence, the price increases because, again, supply is fixed. So, now in the model, we have many more variables than in our initial evidence with the local projection. So we could actually now go to a more larger structural model with time series, and that's what we do next with the VAR evidence. And we can impose, we can identify now the sentiment and the minus shock through sign restriction. In particular, we assume that based on the model, sentiment shocks tend to have an impact on, both sentiment shocks and minus shocks have an impact on prices and volumes, but we know that electricity costs do not have an immediate impact on prices, but they tend to kick in much later. So based on this, here is the evidence. So now this is based on again on Bitcoin data that confirms once more through this let's say third test that if we have a sentiment shock, in this case it's measured through, as I explained before, through the Google Trends. There is an increase in prices and there is an increase in volume. So more optimist trading tend to increase prices. But now we also have extra variables here, so we can also look at the full transmission mechanism. In particular, we can see that if there is an increase in volumes, there is, so to speak, more business for the miners, so more miners enters, and they tend to compete more. By competing more, they want to invest more in the technology, so that's why the excess hash rate goes down, and the confirmation time, so the waiting time between each transaction declines. So search friction decline. Last piece of evidence to confirm, again, the two determinants of prices that we have disentangled so far. Here is the decline in the cost of entry for miners, and as we should expect at this point, prices and volume go up because more miners enter the market, so confirmation time goes down. So to conclude, digital currency are a new growing phenomenon. They are very, very different than traditional currencies. Supply plays almost no role. In the paper we have there is now a very large, extensive and growing literature looking at data and models. And other people have also found that there is very limited role for fundamentals here. There are different views about Bitcoin. Our view is that it's mainly a speculative asset, so it can add pretty much to financial stability. And so we focus very much on the role of sentiments and minus competition. What could be the policy implication for that? Well, sentiments, which we measure with more modern techniques about narrative approach and textual analysis, are linked very much to media. And so, the role of policy here is very crucial in terms of communication. And minus competition, so far, regulators all over the world have almost refused to look at, except for a few exceptions like Bank of England and other central banks, have almost refused to regulate minus competition, but that's probably something that should be done soon because miners are going to affect very much those markets. Done.
Thank you very much.